The American real estate market in 2026 is confusing millions of people. Mortgage rates are still higher than many buyers expected. Home prices in some cities remain expensive. Rent is crushing household budgets. And many Americans are asking the same question right now. Should you buy, hold, sell, or wait? But while average consumers are feeling uncertain, smart investors and financially aware Americans are quietly making strategic real estate moves behind the scenes. They're adapting to the new market instead of fighting it. Because the rules of real estate in 2026 are very different from what worked just a few years ago. Today, it's no longer just about buying the biggest house possible. It's about flexibility, cash flow, risk management, and long-term financial survival. In this video, we'll break down 7 smart real estate moves Americans are making in the 2026 market and why these strategies could define who builds wealth over the next decade. Let's begin. Move number 1, buying smaller homes instead of dream homes. For years, Americans were encouraged to buy the largest home they could qualify for. Low interest rates made bigger mortgages feel manageable. But in 2026, many buyers are changing their mindset completely. Instead of chasing oversized homes, smart buyers are focusing on lower monthly payments, smaller maintenance costs, lower property taxes, reduced insurance expenses, financial flexibility. In many parts of America, people are realizing that being house rich but cash poor creates enormous stress. That's why smaller homes, townhomes, condos, and practical starter homes are becoming attractive again. Some Americans are even intentionally buying below their budget. Why? Because uncertainty changes financial priorities. People now value stability more than showing off square footage. And in a slower economy, cash flow matters more than appearances. Move number 2, moving to affordable secondary cities. One of the biggest real estate trends in 2026 is migration away from ultra-expensive cities. Americans are increasingly leaving places with high taxes, expensive housing, costly insurance, long commutes, high living expenses. Instead, many are relocating to secondary cities with lower costs and growing job markets. Cities in states like Texas, Tennessee, North Carolina, Indiana, South Carolina, Florida suburbs, Midwest growth regions continue attracting residents looking for affordability and better quality of life. Remote work and hybrid jobs have accelerated this trend. People are asking, if I can work remotely, why pay premium prices forever? This migration trend is reshaping both housing demand and local economies across the United States. And investors are watching these areas closely. Because population growth often creates future real estate opportunity. Move number 3, house hacking is becoming mainstream. A few years ago, house hacking sounded like something only finance YouTubers talked about. But in 2026, it's becoming far more common. Americans are buying homes and using extra space to generate income. Examples include renting spare bedrooms, basement apartments, duplexes, accessory dwelling units, Airbnb rentals, shared housing arrangements. The goal is simple. Reduce your housing cost by turning your property into a cash-flowing asset. For younger Americans especially, this strategy is becoming one of the few realistic ways to afford homeownership. Instead of paying 100% of the mortgage alone, tenants or short-term renters help offset monthly costs. In expensive markets, this can dramatically reduce financial pressure. And in uncertain economic conditions, extra income provides security. Move number 4, investors are prioritizing cash flow over appreciation. During the housing boom years, many investors focused mainly on rising home values. People bought properties expecting prices to keep climbing rapidly. But the 2026 market looks very different. Today, smart investors are asking one critical question. Does this property generate reliable monthly cash flow? That means investors are paying closer attention to rental income, vacancy risk, property taxes, insurance costs, repair expenses, local job markets. Speculative buying has slowed in many areas. Now the focus is sustainability. Because in uncertain economies, consistent income matters more than paper wealth. A property that produces stable monthly cash flow may outperform risky speculative investments over time. This mindset shift is changing how Americans evaluate real estate entirely. Move number 5: Americans are delaying home purchases strategically. Here's something surprising. Not everyone rushing to buy in 2026 is making the smartest move. In fact, many financially disciplined Americans are intentionally waiting. Not because they're scared, but because they're being strategic. Some buyers are paying off debt first, saving larger down payments, improving credit scores, watching mortgage rates carefully, waiting for better local inventory. In previous years, people often bought homes emotionally out of fear of missing out. But now many consumers are becoming more patient. And patience can sometimes prevent major financial mistakes. Buying a home before you're financially ready can create years of stress. That's why many Americans now see renting temporarily as a financial strategy rather than a personal failure. And psychologically, that's a huge shift from older generations. Move number 6: Real estate investors are diversifying beyond residential homes. Another major trend in 2026 is diversification. Instead of only buying traditional single-family homes, investors are exploring small commercial properties, storage units, short-term rentals, industrial real estate, RV parks, mobile home parks, mixed-use properties. Why? Because different asset types respond differently to economic conditions. Some sectors perform better during downturns. Others produce stronger cash flow. And experienced investors understand that diversification reduces risk. Many Americans are also investing indirectly through REITs, real estate ETFs, crowdfunding platforms. This allows smaller investors to participate in real estate markets without buying entire physical properties themselves. The modern real estate market is evolving quickly, and flexible investors are adapting faster than traditional buyers. Move number 7: Holding strong assets long-term. Despite economic fears, many experienced investors are not panic selling real estate in 2026. Instead, they're holding quality assets for the long term. Historically, U.S. real estate has gone through cycles: booms, corrections, recoveries, growth periods. Smart investors understand this. They focus on strong locations, stable rental demand, long-term population growth, cash flow sustainability. Because wealth in real estate is often built through patience, not constant buying and selling. And while short-term market headlines create fear, long-term investors often continue building wealth quietly over decades. That's one reason many financially successful Americans still view real estate as a core part of wealth building. Not because it's easy, but because long-term ownership can create leverage, income, appreciation, and financial stability over time. Final thoughts. The 2026 real estate market is no longer about blind optimism. Americans are becoming smarter, more cautious, and more strategic. Today's successful buyers and investors are focusing on cash flow, flexibility, affordability, risk management, long-term sustainability. And perhaps the biggest shift of all is this: people are no longer treating real estate as guaranteed easy money. They're treating it like a serious financial decision. And that mindset could help many Americans avoid major mistakes during uncertain economic times. If you enjoyed this video, subscribe to Smart Money USA for more content on real estate trends, investing, wealth building, recession-proof financial strategies, and the future of the U.S. economy. And comment below. If you had extra money in 2026, would you buy real estate or wait for better opportunities?